it's more important to look at the probabilities versus the possibilities. Because when you say, like, what's the possibility that the market is negative this year? Just because we've seen the market go up 3 years in a row doesn't mean we can't do it for a fourth.
Welcome back. Another episode of Off the Wall here. Markets are moving fast and we're trying to help you stay ahead. So as always, I'm Nate Tonsager, joined by Dave. Dave,
great to see you again, Nate. I'm doing great. You know, it's the second storm that never was.
Right. And I know you spent some time golfing this weekend. So, hey, you even got out beforehand and got back, I guess.
I did. I took the weekend. I went out and saw an old friend in Scottsdale, Arizona. And for those of you who are listening who are golfers, I got to play Scottsdale National Golf Club, which is the home of PXG golf clubs. And it was absolutely beautiful out there, but it was very cold.
Oh, yeah. It's all over the place. So, yeah. Well, we're here for another AMA mailbag episode today. You know, Ask Me Anything is what AMA stands for, but we call it Ask Monument Anything, where we're really trying to answer questions, smart questions that investors are asking right now. And I think before I get into kind of today's topic, you know, Dave, I think we were talking pre-show a little bit. I did really want to quickly touch on the Iran conflict. And I know it's not maybe a conflict yet, but let's call it a situation.
Yeah.
So I would love to kind of hear and pick your brain about what's going on in your mind.
It's definitely a situation. I think I'm not taking a side politically or anything. I think everybody wants to take a side these days on politics. I'm not doing that here. I'm just stating what I see. And I think this administration has just moved beyond the status quo dealing with Iran. I mean, Iran has proved over and over again that they negotiate in bad faith. And this administration has decided to take a different approach to previous administrations on dealing with this. And look, we, the U.S., and frankly, the world, just can't wake up one day to the news that Iran has a functioning nuclear weapon. And then we all say, well, geez, how do we let this happen? I don't think that is a better world. Mostly because I think Iran is literally on the record as saying they want to wipe other sovereign countries off the face of the earth. And let's not sugarcoat the risk of that. That's just not a good thing, and nobody wants to see that happen. Now, the U.S. this is obviously known to everybody, but the U.S. has surged a massive force into the region. And it's possible that by the time this episode airs, something more could have happened. But as of right now, on the 23rd of February, there's 2 carrier strike groups involved. You have the USS Abraham Lincoln, which is already in the Arabian Sea, and then the USS Gerald Ford, which is the largest aircraft carrier in the world, has just crossed into the Mediterranean and is heading east as we record. And so between those 2 carriers, you're looking at something like 150 aircraft, and there's dozens of escort ships and other warships that accompany carrier battle groups, and all of this is within striking distance. And frankly, that's just on the water. Okay. You got on land, there's been over 120 aircraft that have crossed the Atlantic in the past few days. I've seen F-22 Raptors, F-35 stealth fighters, F-16s. There's like 40 tankers and AWACS airplanes. I saw a report of a U-2 spy plane on the ground. And for sure, there are other signals intelligence aircraft that are in the area as well. In fact, the airbase in Jordan, I saw a picture somebody posted of a satellite image. That airbase in Jordan literally has every single parking lot full. And this is the largest U.S. Air Force presence in the Middle East since the 2003 invasion of Iraq. So this is a serious movement of military capability and aircraft. Personally, one thing worth noting is there is no Marine Expeditionary Unit attached to either carrier group. So a Marine Expeditionary Unit is when you see on the news, the Marines are offshore or whatever. That is the nomenclature for a Marine group that is afloat on generally 3 ships. And they are usually around wherever a carrier battle group is, but there isn't one. There's the current Marine Expeditionary Unit that is deployed off the East Coast is still down in the Caribbean dealing with that. So what that tells me is that this buildup is about airstrikes and naval power and not about boots on the ground. So that makes me feel good that it is probably going to be a contained air operation. You layer all of that on top of the troops and the missile defense systems that are already in the region. You've got Patriots, THAADs, et cetera, over there. And the Pentagon is just calling this deterrence, but this is a ready to go strike package. I mean, let's not call it anything other than it is. And if the president decides to pull the trigger on this, the pieces are all in place. But if it brings real concessions, all the better.
I think that like you've laid it out, and this is why I want to start here. First off, because I don't have the background that you do, but I think you add so much value on these kind of topics. And economically, when you think about what could happen if there is a conflict, an actual conflict, whether it's airstrikes, like to your point, maybe not even boots on the ground, it's going to affect the oil market. That is a key export, key resource here in the Middle East. And there's the Strait of Hormuz, which again, I think came up last year quite a bit with a lot of the conflict, especially with the Gaza kind of Israel battle. That is a choke point for trade. So that is going to become a critical waterway, again, from an economic standpoint. Now, I think just candidly, my Nate's opinion here, the Trump administration's actions in Venezuela to secure oil resources, I don't think that was a one-off. I think that could have been maybe a precursor for what is going on now, is maybe to lessen some of the impact from an increase in oil prices, which is very likely in a conflict with Iran. Maybe the Venezuela supply comes online just in time to help kind of support the U.S. So again, I just wanted to quickly touch on it. Not a lot has happened yet outside of just kind of the amassing of the forces. So I have a feeling we will likely talk about this in more detail in a future episode. But I think the questions we got from investors that I really want to spend time on today, and there's 3 of them, is first off, and we've kind of reworded these, make them maybe I'll include a few questions from people, but we got a few questions around Bitcoin. And I think really the sentiment there is, why is Bitcoin getting crushed right now?
Okay.
The other one, which just came up on Friday, so we kind of, scrambled to jam it in because it's such a key topic, is everyone I think is now aware of the Supreme Court's decision to strike down the Trump's tariffs as they are today. What should investors expect going forward? And then finally, and I think maybe the most interesting one for me, is the market has had 3 strong years of performance. So 3 years back to back of very strong returns, 2025, 2024, 2023. But can it continue for a fourth? Do all good things have to come to an end? So Dave, as always, I'll start the drum roll. Which of those 3 do you want to start with?
I say we go with the last one. Can the markets continue its annual winning streak into 2026? Just because I don't want to go off on some other tangent like frigates or anything we did last time. So let's get to the big question, because between this and Bitcoin, we got, and you're right, we took some artistic license to phrase the question, but that one in the Bitcoin, we got multiple questions on. So let's just start there. And, for a long time, the narrative, and frankly, my narrative from time to time, has been that it's been the Mag 7 stocks carry the S&P 500 returns. Okay. So what's been interesting to me now, year to date, we're talking about 2 months, but still, right, there has been a shift. So let's talk about it. And we'll use the beginning of the year just as simply nothing more than just a bookmark in history to talk about this. But what's been interesting is that the number of stocks in the S&P 500 that are outperforming the actual index return for year to date, 2026, seems to me to be the broadest in recent history. There's at least going back to 1990, from what I can see. And that's closing in on around 330 of the 500 stocks in the S&P 500 are actually outperforming the index's return year to date. That's a lot. I can't go. I only went back to 1990. It looks to be the broadest since then. So year to date, we have seen a pretty broad-based move in the markets. So what? Okay, come back to that. The other thing to keep in mind, as it relates to, can this be the 4th year of a positive market, is that the economy is still in expansion mode. Let's not gloss over that. So we've seen 68 consecutive months of positive economic growth, dating all the way back to April of 2020. Okay, so to put that into perspective, the average economic expansion runs 67 months. So we're 1 month ahead of the average number of months that the economy is in expansion mode. The longest streak there is 128 months, and the shortest has been 12 months. Okay. And my final point here is that because I like to follow probabilities more than possibilities, we need to look back at a quick distribution of the S&P 500 annual returns. And what we find out is that the greatest number of positive returns have been stock market annual returns somewhere between a positive 10% and a positive 20%. We've seen 21 different times going back all the way to 1928 where we have had a market return of between 10 and 20%. Now, that's 98 years. Okay. So by comparison, we have only seen negative returns of greater than 10%, 12 out of the past 98 years. In fact, over the past 98 years, we've only seen negative returns 26 of those 98 years. So I think it's more important to look at the probabilities versus the possibilities. Because when you say like, what's the possibility that the market is negative this year? Well, I say, what is the probability of the market being negative or positive this year? And, just because we've seen the market go up 3 years in a row doesn't mean we can't do it for a fourth. So it's like dice. You've just got a higher probability of a positive return materializing than a negative return just based on probabilities. Doesn't mean we'll have a negative return this year. Doesn't mean we'll have a positive return this year. I'm just saying that the probability is greater than just hey, because it's been 3 years, there can't be a fourth. That's just not the right way to look at it, because the market each market day doesn't really care about the previous year or how many other years or what's happened in the past. It's going to do what it does. So that's kind of now finally, okay, Ben Carlson over at, he writes a blog, A Wealth of Common Sense. He just ran through the 15 years of doom and gloom predictions that have been materializing in the press. And it kind of made me bummed that I didn't save these newspaper clippings myself. So thankfully he did, and I'll give him credit for that. But these doom and gloom predictions, right? Like, the double dip recessions, the Dow crashing to 3,000, hyperinflation. There was a prediction of a 64% market crash. I mean, even Jamie Dimon was in the press saying that, there was going to be a pullback, and none of that happened. So every single scary pullback along the way turned out to be a great buying opportunity, which is why spending 95% of your time worrying about things that happen 5% of the time, kind of making some numbers up there, is a great way to scare yourself out of being an investor, a long-term investor, in markets that, like I said previously, have a higher probability of being positive than negative.
I just don't care if the market is up or down in any calendar year. Maybe let's start there.
Yeah, I mean, great point. Right.
What really matters is over long-term time frames, is the market up or down? So again, your probability, possibility, we always live by here. So I'm going to use 30 years of data. Going back to 1993, 6 calendar years, which is, again, an arbitrary date. Like the market from January 1st to next January 1st can be very different than January 2nd to January 2nd. It just doesn't matter on those short time frames to me. But only 6 years, going back to 1993, have had negative return. Average decline is around, to your point, Dave, about 17% in just those 6 years. So out of 30 years, you only are talking about 6. If you look at a 5-year time frame, so not just one calendar year, but over a 5-year time frame going back to 1993, there's only 5 of those that have a decline, and the average decline is about 1%. So sure, in any calendar year, the market could be up or down, plus 10, minus 10, but over the long term, it's down less than in any calendar year, and the average decline goes way down. So what are we really kind of trying to do here? It's not about, can we have another good stock year? It's about, are we going to have multiple years of strength, of maybe negativity? And as the time gets wider and wider, because I know it's hard to plan, you're right. I'm not going to pretend that no one sticks to the same plan for 5 years. You need flexibility. But if you're able to kind of be in the market for 10 years, now there's only 2 declines. 2 declines of that time frame, again, about a 1% decline. So if you can navigate kind of the individual calendar years, you really improve your odds of positive performance. So even if it is a bad year and the stock market's negative, it's not abnormal. It's not a bad thing. But you can't base your whole financial plans. You can't be making all these wild predictions about, I need to get out of the market because, we just can't have another good year. you need to have the flexibility.
Mm-hmm.
And that's really what I think, if I could answer this question for kind of the people that asked it, is it doesn't really matter. Your financial plan can't depend on one calendar year's returns.
I couldn't agree more. And we preach these things over and over again. And I know it gets a little broken record, but I mean, scoreboard, it just it just works. Like, so there you go. I don't know.
Right?
Do you want to dive into Supreme Court next? And
I think we have to, but I think we also need to maybe add like something in the studio, right? Like a literal scoreboard that we can point to for a S&P performance, like winning, losing. Yeah,
right.
Different. We'll workshop that. But all right, I think the second question, because I want to save, I think maybe one that a lot of people ask for the very end, but similar to kind of with the Iran situation, there's a current event going on that we have to touch on because it does have big implications, and that's around the second question that we had, which is, what should investors expect now that the Supreme Court has made the decision to remove the Trump tariffs? And I think I'm going to put a little asterisk on that. They removed them as they were previously, but they're not going to be gone forever.
Right.
I think if you really look at it, it might seem like a major thing that all of a sudden tariff policy is upended. It's really not. Tariffs aren't going away, and we've already seen that. Hours after the Supreme Court's decision, there was already the announcement of a 10% global rate. 2 days later, now it's the 15% global rate. But I think what's important to know about that is a couple things. Is right now, this 15% rate is a bridge. And what I mean by that is these tariffs, as they are today under the current law, which has stronger legal standing, in my opinion, again, not a lawyer, but they're stronger legally, I believe, than what he had previously, can only stay in effect 150 days. He has 150 days. Congress would have to extend it. Now, here's the thing that I think is getting kind of swept under the rug. A lot of tariff rates are coming down for a lot of countries. Now, there are a few that are going up as well. And that's where you're seeing kind of the volatility, is people that had trade deals negotiated are now going to be subject to higher rates. But those who didn't have trade deals negotiated, China being a big one, India, I think I saw South Africa, they all had tariffs up at 50%. They're coming down. But they have 150 days to kind of for Congress to figure it out. And here's, I think, the big is there is a way that they can increase tariffs back to very high rates again, but it requires studies to be done. It requires buy off and sign off from the Commerce or the Secretary of Commerce and other government departments. So really, they have 150 days to run these kind of studies before they can use a different kind of code and avoid Congress altogether. I think this is a good thing, though. I heard someone say, and I think this is really smart, the Supreme Court probably helped prevent a significant economic drawback. Lowering tariffs is going to be a good thing. It's going to make it easier for the Fed to cut rates because inflation won't be going up. Tariffs are going to be coming down. And that's the big thing here, is tariffs are coming down for at least the short term, but there's going to be a lot of volatility as they figure out and run these studies on which industries that they can raise the tariff rate back up on.
Yeah, I think because I agree with everything you just said, but I have to say something. I'll just bottom line it like this. Okay? Look, near term, this is stimulus. Okay. Lower tariffs, potential refunds, better margins, all of that is good for stocks, which is why it's important for listeners to understand that. This can be good for stocks. It's the uncertainty is what comes next. There's my contribution to what I just agree with everything you said, and then there you go.
But the stimulus is going to be on businesses, right? I think a lot of people, when they hear refunds, especially about this, which first off is a nightmare. I can't even, think about your taxes, how much time you have to spend doing personal refunds. Now you're going to have to figure out on the business side, because that's what it is. It's going to businesses. And I think it's very unlikely that if, let's say, Walmart or Costco or Amazon gets refunded all their tariff money, they're not going to send it to the individual households and be like, oh, on January 3rd, you bought $25 of paper towels and it should have only been 20. Here's a $5 coupon. Like there's no way that's going to happen.
Right. No, Nate, it's like this. It's like this. No town puts up a traffic light at an intersection and takes it down 2 years later. That's just, the businesses are going to get a refund because the businesses paid for it. The average consumer is going to say, yeah, but I pay for that in higher costs. The businesses are going to get it. It's going to improve margins, and the stock market's going to go up.
It is. And that's going to help, I think, keep economic growth going too, because companies, again, they really did foot the bill. Now, I don't think consumer prices will be going up, or at least as quickly. Let me say that. I don't think they're coming down in the same way that people think, oh, if tariffs are removed, my prices are going to come down. They're probably going to stay steady.
Mm-hmm.
Companies are going to throw it in their margin bucket or maybe invest in the future. But basically, it's a windfall for companies. Not a bad thing, but I think consumers are way too excited about this, if I'm being honest.
Right. Yeah. Commodity prices may come down. We're a services-based economy. And so, all right. I've said enough on it.
No. I mean, again, I think a lot of people were celebrating it, but I don't know if they really maybe thought about it. I think it was a snap decision, and it's a snap decision meaning, I mean, we talked about this in January at our year-end wrap-up that this was likely to happen, and this was always going to be the outcome of pursuing tariffs in a different way.
Right.
But uncertainty is up, and that's going to shake markets a little bit, right? Like I think I saw they were up on Friday when the announcement happened. That same day, recording on the 23rd, markets are down over 1%. There's just going to be volatility. That's the price you pay for being a long-term investor. So, all right. Well, volatility. There you go. There's my perfect little segue here, because our final question is around a very volatile asset. And I think, again, distilling all the questions we get around this topic into one question: why is Bitcoin getting crushed? So I know, Dave, I have my opinions about Bitcoin, but I'll see. Would you like me to kind of get on my soapbox first, or do you want to
set the stage, and then I'll interrupt you when I want to say something? How's that?
Perfect.
Okay.
Yeah, I got a lot of. I've always had a lot of opinions on Bitcoin, but here's what's going on: is Bitcoin is down about 45%, and probably more than that. It just moved so much. But when I last looked at it, it was down 45% since its peak in mid-October.
Mm-hmm.
So we're talking about basically, let's call it half the value wiped out of Bitcoin in 4 months?
Mm-hmm.
I think a lot of people have owned Bitcoin for various reasons. A big one is it's supposed to be digital gold, where gold rallies or does well when the stock market is struggling. It's a diversifier.
Mm-hmm.
Now, I think what I've always made the argument is Bitcoin is really a proxy for risk, meaning if risk assets are going up, it's going up. Well, it doesn't seem to be doing either of those things right now. And I think that's one of the main reasons it's getting crushed. Like, why do you own it if it's not diversifying your portfolio? And here's what I mean is Bitcoin is down 45%. The S&P 500 is up about 2-ish% over that same time period since like mid-October. So not up a lot, but up some. And global markets are up even more than that with the strength we've seen in international stocks. So you have stocks that are up. Bitcoin is cut in half. And let's not forget about all this global uncertainty that we keep talking about with tariffs, geopolitical conflicts. There's the Venezuelan kind of takeover that happened since Bitcoin has been selling off. Well, gold's up 26%. Real gold. Like, gold is actually doing what it's supposed to and being a hedge for these risky kind of events. Well, Bitcoin, again, it's not going up like stocks, so it's not participating in risk on rallies. And it's definitely not helping diversify anything. So why do you own it? And I've always said people own it as a collectible. That's all it is. Bitcoin is a collectible. I personally won't pay anything for a Bitcoin. So, I don't see a value in it. But some people did. And for a long time, it was greater fool theory. I'm going to buy a Bitcoin today because I can sell it higher to someone else.
Well,
I think we're running short on fools now.
There you go, Nate. I mean, look, I've said this about gold. I'll say it about silver. I'll say it about tulips. I'll say it about anything. Gasoline, oil, doesn't matter.
The great tulip crisis of whatever year, right?
Right. It does not have any earnings. Yeah. It does not have any earnings attached to it. So if you are an investor in Bitcoin, the only thing that you're hoping for is more people will want to buy it and sell it so the price goes up. An investor in any commodity has an investment strategy of hoping other people will come in and buy it for higher than what they bought it for. That's it. Supply and demand. There's more buyers than sellers, or there's more sellers than buyers. So here's my perspective on the Bitcoin thing, because it can't be anything other than supply and demand. Okay. First, there's three things that I think kind of all hit either at the same time or kind of sequentially, however you want to look at it. These three things happen. First one, okay. the leveraged traders, so people who are borrowing money to bet big on Bitcoin, okay, they're getting forced out. Okay. When the price dips, they have to sell, which pushes the price down more, which triggers more and more selling. Okay. And I know this because I can look at it and I can see that the leveraged positions in Bitcoin dropped from 61 billion down to 49 billion. And that happened really, really fast. Okay. So there's your supply and demand in action. People had to sell, created more supply than demand. The price goes down. Simple, like sixth grade stuff here. Okay. No offense to any fifth graders that are listening to this. Okay. Now, at the same time, nearly $3.8 billion has flowed out of Bitcoin ETFs over the last 5 weeks. Okay. And that's the longest outflow streak in a long time, maybe ever. Definitely in a while. Now, when that money leaves, fund managers have to sell the actual Bitcoin to meet those redemptions. Back to supply and demand. There was less demand for the ETFs because people were selling it. So the supply, they had to liquidate. That forces the price down even more. Okay. And then finally, liquidity is thin. There's just not many buyers at every level. So even normal selling moves the price more than it should because just liquidity is thin. So again, supply and demand, if there's just no buyers out there, that's what you mean by thin liquidity, right? There's just not a lot of buyers out there. Here's the way to think of it. It's like, there's not a whole lot of liquidity in $25 million homes because not a lot of people can buy them. So when liquidity is thin, this is what happens. Okay. Selling is going to move the price way more in a thin market than in a crowded market. Okay. So this is the story. Leverage unwinds, ETF outflows, thin liquidity. That's the story.
What's interesting then to me is, well, what's going to bring demand back for all the people that are, buying at this level? And again, I don't want to make a recommendation specifically of like, is Bitcoin a good buy now for the long-term future? But what I'm going to be watching is what brings demand back. This is the Trump administration is one of the most friendly administrations to crypto assets. So you have a friendly government. You have the ETFs that launched last year to kind of open up the people that could buy it. What catalyst is going to cause people to come back in? And I think, Dave, to your point, it becomes a self-fulfilling cycle when it gets into these kind of spirals.
I think the answer is the opposite of what I just said, right? It's the reverse of what I just said. It's the thin liquidity becomes more crowded, right? The market becomes more crowded with buyers. There then are ETF inflows. People are going to take their cash and buy ETFs. And then that's going to create more leveraged buyers who start to, rather than unwinding, are going to wind up their positions by borrowing money on. It's just the reverse. Because of supply and demand, it's going to be the exact reverse of what I said. That's what I think.
You're right, but here's the thing: is I don't know who's going to start that reverse.
Oh yeah, I know.
You kind of need it to go right, like all that becomes self-fulfilling in both the up and down markets, which is why momentum investing, I think, is also people were using Bitcoin. When the price was moving higher, again, we talk about momentum at Monument all the time, is that assets that are moving higher in price tend to continue moving higher in price until something shifts. And then when they start moving lower, they continue moving lower until there's that kind of moment, that shift. I don't know what's going to cause that.
Right.
I think I'm just, and maybe this is my pessimism around it coming in overall, but if I lost 40% on a Bitcoin trade and lost it in 4 months, and I'm just Joe Schmo who bought the ETF, emotion's going to come in and I'm going to be like, well, screw that thing. I'm never owning that again. Why would I do that to myself?
Yeah.
I think it's going to take some
Bitcoin's
kind
down
of
4% today.
It's going to take some kind of an event to like really, I think, get people excited about it again. Because I think last year with, again, the launch of the ETFs, Trump administration's first year being very friendly, I think everyone just got out over their skis, and now we're seeing kind of the unwind of that trade. And so I don't know, I'm just going to be really interested to see what is the event. Is it going to be that you can actually start using Bitcoin to pay for everyday things? Is that actually be what's going to kick it up? Because right now, to your point, Dave, it's a commodity. It's not a currency. Right. So I hate that we call them cryptocurrencies. They're crypto commodities.
Right. Well, here's one way you'll know is because the questions coming in to Ask Monument Anything will change from why is Bitcoin getting crushed to why is Bitcoin on a rally? There you go. You'll know.
It'll
right?
be
So
it'll be your old barber shoe shine kind of thing. Is like they're asking you, like, is Bitcoin a buy here?
right,
It's like,
right,
I can't.
exactly. So
Well, to everyone who made it to the end of the episode, thanks a lot for listening. You know, you got a little bit of our, we seem to have got a military kind of theme a little bit here, but also too, it's all of that is having an impact on the market. So really do appreciate everyone who kind of submitted their questions. If you want us to answer your question in our next Ask Monument and Anything segment, a couple ways you can get it to us. Comment on any of the YouTube videos, on any of the podcast platforms where you're listening. You can also do this thing called emailing, which I don't know if is a dying breed, but you can also email it to us. And the email address there is offthewall, all one word, at monumentwm.com. And, we're constantly releasing new episodes. So we always like to make sure people know that the easiest way to find them, you'll never have to look for them. Just subscribe wherever you're kind of looking or listening to them. They'll be right at the top of the feed every time we drop a new one, whether it's an AMA episode or we do record some around some other portfolio topics. So always the easiest way to find us, just subscribe.
right. And I'm always happy to answer the military questions that come in because they're always around current events. But look, I mean, if anybody listening out there wants to hear me talk about ham radio, I can talk about that too. So, we can talk about parks on the air. We can talk about wave propagation theory. We can talk about the ionosphere. Like I can talk about more than just military assets. I just want everybody to know. Or golf.
We'll see if we can weave it in next time.
Yeah, right. All right. Well, with that, we'll see everybody on the next episode of Off the Wall, and take care.
The content presented by Monument Capital Management LLC is intended for general informational and educational purposes only. No portion of this content should be construed as the receipt of or a substitute for personalized investment, financial, legal, or tax advice. Monument is neither a law firm nor an accounting firm, and no content should be interpreted as legal or accounting advice. Any discussions of investment strategies, financial planning concepts, or related topics are general in nature and may not be appropriate for every individual or situation. Different types of investments involve varying degrees of risk, and there can be no assurance that any investment strategy, planning approach, or discussion referenced will be profitable, suitable, or successful for any particular person or circumstance. Past performance is not indicative of future results. From time to time, this content may reference hypothetical situations, illustrative examples, or stories that do not involve actual Monument clients. These scenarios are designed solely to illustrate concepts or demonstrate how Monument might approach similar situations and should not be interpreted as endorsements, testimonials, or guarantees of any particular outcome. No two clients, situations, or experiences are exactly alike, and results will vary. Nothing discussed should be interpreted as a guarantee that any client or prospective client will experience a specific level of results or satisfaction if Monument is engaged or continues to be engaged to provide investment advisory services. Monument's investment advisor's registration status or any prior experience should not be construed as an assurance of future performance or success. Copies of Monument's current Form ADV Part 2A, Disclosure Brochure, and Form CRS, which discuss our advisory services and fees, are available upon request or at www.monumentwealthmanagement.com/disclosures.